Hey, what's going on, everyone? This is Hisham Saeed. I'm a faculty in civil engineering, Santa Clara University, and in this video, it's the first part of a couple of videos covering this lesson here about borrowing and lending, or simply loans, and how to calculate some detailed components of the loan payments back. So in this, how to differentiate between the two parts of any loan payment or payback payment, so the interest and principal payments, and then learn how to use ready formulas for us to calculate each one of these. So loans here are, just to recap, are one of the debt instruments or ways to get debt, which debt is one of the ways to get capital for a project. So loans here are paid back with different ways. And just to go back here, so one of the ways to get debt into a project is through bonds. And debt is, or loans are the second way of getting debt as money or as capital to a project. So loans here are paid back in different ways, and you can agree whatever agreement you have with the bank or the entity that gives you the loan. You can agree of how to pay back this loan. But the common way is just equal payments back over a period of time, and these equal payments are calculated based on whatever interest rate is in the agreement. So for each one of these equal payments, you can think of it as it's divided into two parts. One is paying back the original principal amount, and the second part is used to pay back the interest that is accumulating over the time. So why is this important? The two parts here, the principal and interest payments of the bigger loan payment that you make in every month or in every year. So it is important to know how much you pay for the tax, which is any money above the original principal, because it has a relationship to taxes. It can help you when you file taxes and calculate your taxes, because it will be tax deductible here, and you can claim it as and reduce the amount of taxes that you owe to the government. So let's just illustrate this concept by this example here, that Sally borrowed a loan of $10,000, and it needs to be paid back in 4 equal payments, and the lender here interest rate is 10% per year. So always start with drawing a cash flow. So let's draw the cash flow for Sally here. So you have 4 years, 1, 2, 3, and then 4, and then Sally here gets the first part of the cash flow here is getting 10,000, and then the second part here is paying back this 10,000 in 4 equal payments. So you can see it's a annual uniform series, or 4 equal payments. And now the question is, how much is each one of these payments? So how to get this, how much Sally will pay for each of the following years. It's calculated simply by using the A given P formula or table value. So you have the P value, which is the amount of the loan in the beginning, and then it's A given P, the 10% interest, and 4 equal payments. So you end up with this value, and this is the table interest factor that you get from the table, or you can calculate it using the formula. So now we see here we'll try to keep track of the loan payments that are paid to recover that, and now try to break down each one of these into interest and principal payment, and at the end of each period, what is the ending balance, so it will be moved to the beginning balance of the next period. So for the first year, you have beginning balance as that, and at the end of this year, you pay this amount. But this 3,154.7 used to recover the interest that incurred or happened during the first year. So if you have a 10,000 beginning balance and over 1 year you have 10% interest, so the calculated interest here will be this value. So whatever value left out of this 3,154.7 after taking out 1,000 interest, principal payment. So together they add up to the amount that you pay in this year, and this principal payment will be used to reduce the principal amount that you have. So at the ending will be simply the 10,000 minus the amount that you pay. Then this is the ending balance, and then the ending balance will be the same as the beginning balance of the second year. And then keep going with that. So for this is the beginning balance that will be used to calculate the interest of this year. So 10% of that, this will be the interest payment, and the difference between the loan repay amount and the interest payment will be the principal payment, and then the beginning balance minus the loan payment. So you will end up with this value. You copy it and keep going. So you see here, keep going with this process of differentiating between the interest payment and the principal payment. And at the end, you see the ending balance will be 0 because we calculated the loan payments based on this formula as the 10% required of the loan, and at the end you should exactly end by $0, or Sally here paid back all the loan. So and we see here also, good thing we did this in detail over the 4 years and trying to keep track of the interest and principal. So we see here at the beginning the interest is big, 1,000, and then decreasing. And it's decreasing because you keep paying parts of the loan. So whatever balance left is decreasing, so the interest calculated is decreasing also. And then we see here the amount of the principal payment is increasing with the time over the payments, or over the number of payments you make. So it's just interesting fact here that the interest in the beginning is big and then it keeps decreasing because the ending balance or the starting balance is decreasing while Sally or whatever got the loan pays back the loan. So this is the end of the first part, and we'll see in the second part now how to get up formulas to calculate each one of these parts without the need to go through this whole process and this thing. So I will see you in the second video of this series about loans, borrowing and lending, and I will explain to you the use of the formulas. Okay.